Hey everyone, and welcome to The Explainer. Today we are completely pulling back the curtain on the hidden mechanics of Forex brokers. We're going to break down the exact, under-the-hood systems that bridge your personal device to the massive global financial market. Because honestly, understanding this plumbing is absolutely crucial. It is the ultimate key to protecting your capital. So let's dive right in. Think about this for a second. What actually happens when you tap that glowing buy button on MetaTrader 4 or 5? Most people assume you just click a button, a trade opens, and you sit back and watch the numbers flash red or blue. But in reality, you've just kicked off a wildly complex mechanical journey. And if you don't know who is handling that journey behind the scenes, you're flying completely blind in a pretty ruthless market. All right, let's start with Section 1, the Forex broker bridge. So as a retail trader, you can't just walk up to the global interbank market and buy currency. You need a bridge. And that bridge is your broker. When you register with well-known companies like Exodus, IC Markets, or Pepperstone, they are instantly handing you an entire arsenal of tools. They set you up with a trading account, they give you leverage to boost your buying power, they stream the charting data directly to you, and most importantly, they execute your buy and sell orders. They are literally your gateway to the whole shebang. But here's the thing, the broker isn't the origin of the market itself. They're actually connecting you to what we call liquidity providers. We're talking about the massive global heavyweights here. Big banks like JP Chase, Goldman Sachs, and Citibank, along with huge financial institutions and hedge funds. These giant entities are constantly throwing out buy and sell prices. Your broker's job is just to collect this massive, nonstop stream of institutional pricing data and display it on your chart. That exact feed is the reason the price is ticking up and down every single second. Moving on to Section 2, how brokers make money. Okay, so the crucial piece of the puzzle here is understanding the spread. This is the primary way brokers take their cut. Let's just walk through the math real quick using gold or XAU/USD. The broker basically gives you two prices. You've got the ask price to buy, let's say it's at 3350.20, and the bid price to sell at 3349.90. Now, the difference between those two numbers is exactly 30 points. That right there is the spread. Every single time you enter a trade, you're paying that tiny difference to the broker. Multiply that tiny amount by millions of trades a day across all their clients, and you can see exactly how this bridge makes its money. But the spread isn't their only revenue stream. On certain account types, like raw or ECN accounts, where the spread is basically zero, brokers will instead charge a flat commission. This is usually around $3 to $7 for every standard lot you trade. Plus, if you decide to hold your trades overnight, you're going to encounter swaps, which are essentially overnight interest fees applied to your account. So yeah, it's a highly efficient, incredibly high-volume business model. Let's look at Section 3, Types of Forex Brokers. This brings us to a really important showdown between the two major categories of brokers. First up, you have market makers, also known as dealing desks. They literally make the market for you. If you want to buy, they might internally sell to you, which means mathematically your loss can actually become their profit. Now, they do offer fixed spreads and they're great for smaller accounts, but obviously there's a bit of an inherent conflict of interest there. On the flip side, you have ECN or STP brokers, which operate with no dealing desk. They route your order directly to those big liquidity providers we talked about. Because they offer raw spreads, they're usually much better for scalping, and they make their money on those commissions or a super small spread markup, rather than trading against you. Which leads perfectly into Section 4, behind the trade execution. I want you to imagine you just clicked buy on gold. Boom. In a fraction of a second, your order blasts from your MT5 terminal straight to the broker's server. Instantly, their automated systems run a check. They verify your balance, they check your margin, and they confirm your lot size. If everything gets a green light, the order is routed, either internally or straight to a liquidity provider. The trade executes, a ticket is generated, and the price on your screen starts moving into profit or loss. And guys, all of these incredibly complex checks and balances happen literally faster than you can blink. Now for some of the systemic risks in Section 5. Slippage, leverage, and stop hunting. First up is slippage. Have you ever clicked buy at a very specific price, but then your trade actually opens at a slightly different, usually worse price? That is slippage. It happens because the market is just moving too rapidly. This is especially true during major news events or times of high volatility on pairs like XAUSD or GBP/JPY. Basically, the exact price you clicked on literally doesn't exist anymore by the time your order reaches the server. It's just a mechanical reality of trading in a fast-moving market. And this brings us to the most dangerous tool in your entire arsenal, leverage. Brokers are essentially loaning you buying power. If you have 1 to 100 leverage, a mere $10 in your account allows you to control $1,000 in the actual market. Now, that sounds amazing for scaling up your profits, right? But here's the catch. Leverage amplifies your losses in the exact same way. It is absolutely the #1 systemic reason why so many retail traders blow their entire accounts in a matter of days. So why do most traders actually lose? Well, it's super easy to point the finger at the broker, but the overwhelming majority of retail losses come directly from the trader's own habits. We're talking about over-leveraging, revenge trading right after a tough loss, completely ignoring basic risk management, trading in terrible market conditions, and just letting emotions drive the wheel. Now, sure, unethical brokers can totally make things worse through spread manipulation or delayed execution, but mostly the broker's just providing the bridge. It's the trader who decides to drive off the edge. Which brings us to the controversial reality of stop hunting. You've probably seen this. When the price spikes to the exact spot where everyone placed their stop loss, knocks you right out of the trade, and then immediately reverses back in your original direction. Infuriating, right? Now, bad brokers can sometimes manipulate their own price feeds to do this, but more often than not, this is just real market mechanics at play. Large institutions need massive liquidity to fill their giant orders, so they purposefully sweep the obvious areas where retail traders place their stops. It's exactly why smart money traders heavily study things like liquidity, order blocks, and equal highs and lows. You also have to remember the broker is a business, and they are absolutely going to protect themselves mechanically. If your highly leveraged trade goes so far into the negative that you're about to run out of actual money, the broker's automated risk systems will step in. They'll issue margin calls and ultimately trigger what's called a stop out, which automatically forces your trades to close. They do this to ensure your account doesn't go into a negative balance where you actually owe them money. It's cold, it's calculated, and it is entirely automatic. Let's wrap things up with Section 6, the simple, real truth. First things first, you have to choose a legitimate bridge to the market. You want to look for brokers with strict financial regulation, tight spreads, fast execution, seamless withdrawals, and just a really strong overall reputation. On the flip side, you need to run far away from the red flags. Avoid any broker promising guaranteed profits, offering those absurdly massive deposit bonuses, or anyone trying to manipulate your signals. Your broker should be a silent, incredibly reliable partner. They shouldn't act like a flashy salesperson. And here is the absolute, unvarnished truth derived from everything we've covered in this explainer today. The market itself is not designed to help retail traders win. It's a highly efficient, ruthless mechanism. Brokers survive beautifully precisely because traders trade frequently and emotionally. The market system itself only really rewards 4 things: cold discipline, endless patience, rigid risk control, and flawless consistency. So the ultimate takeaway is quite simple. Professional traders focus on capital protection instead of chasing fast money. Once you truly internalize that you are trading in a highly systematized environment, one controlled by massive institutions and super fast automated broker algorithms, the whole fantasy of getting rich quick kind of dies. Your only real job is to manage your risk, focus heavily on consistency, and just survive the mechanics of the game. So I want to leave you with a provocative thought to chew on. Now that the curtain is fully pulled back, now that you know exactly what happens to your order in those milliseconds and exactly who is sitting on the other side of your screen waiting for your liquidity, how will you manage your risk tomorrow? Thank you so much for exploring this fascinating topic with me in today's explainer, and I can't wait to dive into our next subject with you very soon. Catch you next time.